I am the superpower and I control this world.
When people observe the modern world with its flashing stock markets, endlessly moving exchange rates, and constant headlines about inflation, debt, and economic crises, they often feel a deep but unspoken confusion. How did one single currency, printed by one nation, become the central nervous system of the entire global economy? Why is it that oil, weapons, international trade, foreign debt, reserve holdings, and even emergency bailouts are all ultimately tied to the same green pieces of paper? Why does the Indian rupee rise and fall within hours? Why does the Japanese yen carefully balance its value? Why is the Chinese yuan tightly managed? Yet the U.S. dollar moves freely across borders without fear of rejection or limitation. Why is it that when people calculate wealth, risk, or power, everything is measured against the dollar, but the dollar itself is rarely questioned? And why do economists, developers, policymakers, and investors endlessly debate land development, infrastructure, productivity, and growth, while avoiding the most uncomfortable question of all: who controls the foundation of money itself? And how did that control come into existence? To understand this, we must step away from simplified explanations and patriotic myths and instead open the deeper pages of history, because the dominance of the U.S. dollar was not a coincidence, not a moral victory, and not the natural outcome of free markets. It was a result of timing, geography, war, destruction, fear, trust, and deliberate strategic decisions made at moments when the rest of the world had no better option. The story begins long before the word globalization was ever spoken, with a lesson older than economics itself, a lesson told in villages, classrooms, and homes across cultures. When two cats fight, the monkey takes the bread for much of the 20th century. Europe was locked in a brutal internal struggle, and America stood outside the battlefield, watching. Carefully, when the First World War erupted in 1914, Europe, which had been the industrial, financial, and technological heart of the world, turned its immense productive capacity inward toward destruction. Factories that once produced machines and consumer goods were repurposed to manufacture weapons. Railways were redirected for military logistics, and entire generations of young men were sent into trenches that swallowed lives at an industrial scale. International trade collapsed, shipping routes were disrupted, and the intricate financial networks that had connected Europe to the rest of the world began to break apart. Basic necessities such as food, fuel, medicine, and clothing became scarce. Inflation surged, and governments printed money desperately to finance the war effort. While Europe was tearing itself apart, one nation remained geographically untouched, industrially intact, and economically alert: the United States of America, protected by two vast oceans and blessed with abundant natural resources. America did not experience the physical devastation of war on its own soil. Its factories continued to operate, its farms continued to produce food at scale, and its banking system remained functional and increasingly influential. As European nations exhausted their savings and strained their economies, they turned outward in desperation, seeking weapons, ammunition, food, fuel, medical supplies, and industrial equipment. America offered all of it, but not for free. Payment was required, and payment would be accepted in one of two forms: U.S. dollars or gold for nations fighting for survival. This was not a negotiation, but a necessity. Gold reserves that had been accumulated over centuries were shipped across the Atlantic, quietly and steadily, filling American vaults. By the time the United States officially entered the war in 1917, a significant portion of the world's gold had already moved into American hands. America's military involvement, while decisive, was relatively brief compared to years of devastation endured by Europe. When the war ended, Europe lay financially drained and physically damaged, while America emerged not as a ruined victor, but as an enriched supplier. The center of gravity of global finance had shifted, even if most people did not yet realize it. But history was not finished repeating itself. 2 decades later, the world plunged into an even more destructive conflict. When the Second World War erupted in 1939, Europe once again became the primary battlefield. Cities were bombed into rubble, industrial zones were destroyed, civilian populations were displaced, and entire economies collapsed under the weight of total war once again. The United States initially stayed out of direct combat, while its industrial engine shifted into overdrive. American factories produced tanks, aircraft, weapons, vehicles, fuel, and food at a scale the world had never seen. Programs like Lend-Lease allowed the U.S. to supply its allies while securing long-term financial and political leverage. And once again, payment flowed toward Washington in the form of gold, assets, influence, and future obligations. By the time the United States formally entered the war after the attack on Pearl Harbor, much of Europe's industrial and financial capacity had already been shattered. When the war finally ended in 1945, the contrast was stark. Europe and large parts of Asia were physically destroyed, socially traumatized, and economically exhausted. The United States, by contrast, stood untouched at home, its cities intact, its factories modernized, its workforce experienced, and its vaults filled with gold. Estimates suggested that the U.S. now held close to two-thirds of the world's official gold reserves, yet victory created a new and dangerous problem. The global economy could not function in ruins. Trade had to restart, currencies had to be trusted, and nations had to rebuild. But trust was in short supply. Every country faced the same dilemma. Why should we accept another nation's currency when their economy is unstable, their government is weak, and their money may collapse tomorrow? The pre-war gold standard had already shown its limitations, and no single European nation had the credibility or resources to anchor a new global system. In this vacuum of confidence, the United States stepped forward not as a conqueror, but as a guarantor. In July 1944, even before the war had fully ended, representatives from 44 nations gathered in Bretton Woods, New Hampshire, to design a new international monetary system. The discussions were technical on the surface, but deeply political beneath. The question was simple yet historic. What would serve as a foundation of global trade and finance? The answer, shaped by power rather than idealism, was the U.S. dollar. Under the Bretton Woods system, the dollar would become the world's primary reserve currency. To make this acceptable, the United States offered a critical promise. The dollar would be convertible into gold at a fixed rate of $35 per ounce. Other currencies would be pegged to the dollar, and the dollar would be pegged to gold. This structure appeared balanced, and disciplined nations could trade using dollars with confidence, knowing that those dollars represented a claim on gold held by the U.S. Central banks deposited their gold reserves in American vaults, believing they were safeguarding stability. International trade expanded rapidly. Reconstruction began, and for a time, the system seemed to work. Europe rebuilt its factories, Japan modernized its industry, and global commerce flourished under the assumption that the dollar was as good as gold. But beneath this apparent stability, a structural imbalance was quietly growing. The United States enjoyed a unique privilege no other nation possessed. It could pay for imports, military bases, foreign aid, and overseas operations using its own currency. While other nations had earned dollars through exports, America could simply create them as. Years passed, U.S. spending expanded, military commitments grew, social programs increased, and foreign interventions multiplied. Dollars flowed outward faster than gold flowed inward. Some countries began to notice. By the late 1960s, nations such as France openly questioned whether the United States still possessed enough gold to back all the dollars circulating globally. Demands were made to convert dollars into gold. Pressure mounted, and the foundations of the Bretton Woods system began to crack. With this shift came quiet efforts to reduce reliance on the dollar. China promoted trade settlements in yuan. Russia demanded payments in rubles for certain exports. Regional agreements were signed using local currencies. Central banks slowly diversified reserves into gold and alternative assets. The term de-dollarization entered mainstream discussion, yet progress remained slow and fragmented. The reason was structural. Replacing the dollar required more than economic size. It required deep financial markets, military reach, political influence, legal infrastructure, and global trust. The United States still possessed all of these at scale. Its bond markets remained the deepest and most liquid in the world. Its military guaranteed shipping lanes and energy routes. Its institutions, despite criticism, offer predictability compared to many alternatives, and perhaps most importantly, the existing system benefited too many participants to be abandoned easily. Nations complain about dollar dominance, yet continue to rely on it. Businesses prefer stability over experimentation. Crises reinforce the pattern. During global shocks, capital flowed not away from the dollar, but toward it, reinforcing its role as a safe haven. This paradox defined the modern era. The dollar was criticized, yet indispensable, distrusted, yet demanded, fragile in theory, yet resilient in practice. The future remains uncertain. Technological shifts, digital currencies, regional alliances, and geopolitical tensions continue to reshape the landscape. But the lesson of history remains clear. The dollar did not rule the world because it was fair or flawless. It ruled because it emerged at the right moment, from the right position, backed by unmatched industrial capacity, military power, strategic planning, and an ability to shape the rules of the system itself. Money, in the end, has never been just about numbers. It has always been about power, trust, and the ability to enforce belief. The story of the dollar is not a mystery hidden behind conspiracies. It is written openly across a century of wars, agreements, crises, and decisions waiting for those willing to look beyond the surface. And as long as no alternative can replace not just a currency, but the entire structure supporting it, the dollar's dominance, however challenged, continues. As confidence quietly eroded, the United States found itself facing a dilemma that no empire before it had experienced in quite the same way. It had become the center of the global monetary system. Yet that very position now threatened to expose its weaknesses. Foreign governments held vast amounts of dollars, and if too many of them demanded gold at the same time, American vaults would empty, revealing the fragility of the promise that had sustained Bretton Woods by the end of the 1960s. The contradiction was impossible to ignore. The United States was fighting an expensive war in Vietnam, maintaining military bases across the globe, funding allies, and expanding domestic social programs. All while its gold reserves were declining, dollars were being printed far faster than gold could ever be mined behind closed doors. Policymakers understood that the system could not survive much longer in its original form. Then, on August 15, 1971, President Richard Nixon addressed the American people and, by extension, the entire world in a brief televised announcement. He declared that the United States would suspend the convertibility of the dollar into gold with that single decision. The gold standard effectively ended the promise that had anchored global trust for nearly 3 decades was quietly abandoned. There was no international vote, no negotiation, and no alternative offered. The world was informed, not consulted. Reactions ranged from shock to anger, but resistance was limited by reality. Most countries no longer possessed the gold they had once held. Their reserves were now dominated by dollars. Rejecting the dollar outright would have meant financial collapse, frozen trade, and economic isolation. Reluctantly, the world accepted a new system. The dollar became a fiat currency, backed not by gold, but by confidence, habit, and American power. This transition marked a fundamental shift in the nature of money itself. For the first time in modern history, the global reserve currency was backed by nothing tangible. Yet, paradoxically, its dominance increased rather than declined. Still, a new risk emerged if the United States abused its ability to print unlimited money. The dollar's value would erode, inflation would spread globally, and confidence would eventually collapse. American strategists understood that fiat money alone could not sustain global dominance. Something else was required to anchor demand. That anchor was oil. During the early 1970s, energy had become the lifeblood of modern civilization. Transportation, electricity, manufacturing, agriculture, and military power all depended on steady access to petroleum. Without oil, economies would grind to a halt. Recognizing this, the United States moved decisively. Agreements were forged with major oil-producing nations, particularly Saudi Arabia and other key states in the Middle East. The arrangement was simple, elegant, and ruthless. Oil would be priced and sold exclusively in U.S. dollars in return. The United States would provide military protection, political support, advanced weapons, and security guarantees for oil-producing regimes. This arrangement created what became known as the petrodollar system. Its implications were profound. Any country that needed oil now needed dollars, and every country needed oil. This forced global demand for dollars. Regardless of how many were printed, dollars that flowed to oil producers were then recycled back into U.S. financial markets through investments in treasury bonds, banks, and assets. This closed loop allowed the United States to finance deficits, wars, and consumption on a scale no other nation could sustain. The dollar was no longer just money. It became the bloodstream of global energy and trade. Over time, this system was enforced not only through contracts, but through power. Leaders who openly challenged the dollar's role in energy markets faced consequences. Iraq's Saddam Hussein announced plans to sell oil in currencies other than the dollar. Soon after, Iraq was invaded, its government dismantled, and its economy reshaped. Libya's Muammar Gaddafi proposed a gold-backed African currency to challenge dollar dominance in regional trade. Libya descended into chaos following foreign intervention, and the proposal vanished with him. Whether viewed as coincidence or strategy, the message received by the world was unmistakable. The dollar system was not optional. It was enforced, yet history does not stand still. As the 21st century unfolded, new powers began to rise. China transformed into the world's manufacturing center. Russia reasserted control over its resources. India emerged as a major consumer market and technological hub.